Hello, and thank you for joining me today for a discussion about investment allocation strategies in a hard market. My name is Dan Burns. I'm a senior portfolio manager and principal at AAM. If you're not familiar with AAM, we manage investment portfolios for insurance companies and pools around the country. In my role, one of my primary responsibilities is to lead our relationships with our government risk pool clients. And as such, I get to participate in a lot of discussions with our clients nationally and learn about some of the challenges they're facing. Particularly on the property and liability side, we hear a lot about social inflation and the impact that's having on reserves, economic inflation and the impact that's having on claim costs, and certainly the hard reinsurance market and the challenges of placing coverage. And if you can place coverage, the cost of those coverages. Given our role, inevitably the conversation shifts to a discussion about how the investment portfolio can support our clients throughout these challenges. And so today I wanted to share some of the common themes we see and discussions we're having about investment portfolios and investment allocations in a hard market. I'll do this with three questions that we'll walk through. The first is, what is the one question we think pools should be asking about their portfolio right now? The second, are significant changes in portfolio strategy warranted? And the third, what sectors of the market are attractive today? We'll start off and talk about question one, the first key question. And in our view, the question everyone should be asking is, what is the liquidity position of the portfolio? You want to ensure there's enough cash held aside to limit the risk of forced sales. As everyone's well aware, bond returns over the last 18 months have been very challenging. Using the Bloomberg Aggregate Index, the bond market return since the beginning of 2022 is negative 13%. If your duration of your portfolio is a little bit shorter, your return might be a little bit better. If your duration is a little bit longer, it might be a little bit worse. But what's important is that negative 13% includes the coupon payments you've been receiving. So for most pools, your bonds are underwater by 15 or 20% or sometimes more. What you've inevitably heard from your investment team, and I'm sure your board has heard often, is that if you hold those bonds to maturity, you won't realize any losses. As bond prices get closer to maturity, price improves, and at the day of maturity, there is no realized gain or loss. So again, the key is ensuring you don't have to have a significant amount of sales in the portfolio. Now, what tends to drive sales? One are portfolio management decisions. A second often driver of sales are claims activity. Reinsurance payments are a third, and finally dividend payments to members that are a fourth source of liquidity needs in portfolios. On the portfolio management side, that's pretty straightforward. Your manager might like bond A better than bond B, so they sell bond B and buy bond A. It's important to have a conversation with your manager up front about your expectation for realized losses in the portfolio, so you don't wake up at the end of a quarter, at the end of your fiscal year, and realize there's been a significant realized loss in the portfolio due to trading activity. That can really be headed off up front with a few simple conversations. Claims activity certainly can be unpredictable, and there can be some significant large claims and settlements. In our experience talking to clients, a lot of that has to do with the fact that the courts are still catching up from the COVID period today. That can be challenging, as can the reinsurance component of cash flow needs. As I said before, and you're well aware, it is challenging to place your reinsurance, and often clients don't know what that reinsurance is going to cost until the very end of that placement. So those can be the more challenging areas when it comes to cash flow needs, and really something we need to think about long and hard. But things happen. At some point, every pool that we've worked with has needed some cash out of the portfolio. So we want to talk about some ways we've addressed that with our clients over time. First of all, when a client calls for cash, our first assumption, and I think most of our clients, is, well, let's just sell a few bonds. And I think that largely is because the bond portfolio is designed to support your liabilities. But maybe today it's worth thinking about it a little differently and consider pairing some of your risk assets, your equities or high yield bonds. In 2022, the returns of the equity market and bond market were about the same, both terrible, But since they went down about the same, that means the allocation today, at the end of 2022, excuse me, it was about where it was at the beginning of 2022. What's happened in 2023 is a little different. Bond returns are about flat, but the stock market is up 15, 16, 17%, depending how you want to look at it, and sometimes more. What that means is in some portfolios, the allocation to stocks has grown pretty considerably just simply due to market moves. So again, back to this idea, if you need cash, perhaps it's a good time to look at that allocation, reduce some of your equities back to whatever your target is, and that will accomplish a few things. One, it aligns your asset allocation likely with policy. Two, it generates the cash you need. And three, importantly, many of those equity allocations have been held for a long time, so there's a pretty big embedded unrealized gain. So selling will realize a gain that might not give you everything you need in terms of cash, but then you can sell some bonds, likely at losses, and often come out with net neutral gain or loss, or in some cases, have a realized gain overall. So think about your asset allocation if you need some cash out of the portfolio. Second, consider a letter of credit with a bank for short-term cash needs. We have one client who has used this successfully for a number of years. And in our view, where it works best is, again, just for a short-term cash need. For example, you have several claim settlements that are going to have to go out in the near term, but you don't expect your reinsurance payment to come in time to support that. So instead of selling securities to pay the claim to get your reinsurance recoverable to buy securities again, you can use a letter of credit to cover that short-term outflow. And when you get your reinsurance payments in, repay the bank. Economically, the way that makes the most sense is if the letter of credit charge or cost of the letter of credit is less than the yield of your portfolio, it's probably a pretty economical way to do that. Those don't get set up overnight, so it's worth maybe having a preliminary discussion with your bank and seeing if it's appropriate for your pool. Fourth, portfolio structure, and this is a bit of a broader topic, but having a duration target or maturity target in your portfolio that's pretty well aligned with your expected claims payments will be important to help you meet cash flows over time. That really is the best way to mitigate the risk that you have to sell significant securities to pay claims. And so if you haven't thought about that in a while, you're not entirely sure why the duration of your investment portfolio is the way it is today or the way it's positioned today, this is a good time to revisit that and make sure your assets and liability cash flows are reasonably well aligned. The fourth one I'll talk about, and I'm going to spend a little bit of time on this, is establishing a liquidity portfolio. So a liquidity portfolio, in our view, is just that. It's a separate portfolio that sits between your operating cash balances and the strategic long-term portfolio investments of stock, bonds, high yield bonds, etc., and has a very specific purpose in this environment. This is a portfolio our clients have been using for a number of years and done so successfully. And I want to talk about a few of the characteristics of what these liquidity portfolios look like. First of all, they're short-term in nature. If you have an upcoming payment you're aware of, whether it be reinsurance or dividends, you can buy a few short-term securities to match that cash outflow so you're not caught by surprise when it comes. That's one component of the liquidity portfolio, but the bigger component is then building what we would call a laddered approach of short-term investment options. Every couple of weeks or month or so, you might have bonds that are maturing. That way, as claims come due, as settlements come due, you always have cash coming off the portfolio, this liquidity portfolio, to meet those claims. A second key characteristic is that these are very high quality and liquid investments. Today, given the yield environment, we're largely using treasury bills or T-bills. In the past, we've also used asset-backed securities, but making sure they're liquid through cycles is important because while these portfolios might be laddered with maturity every month, occasionally you still might need to sell. And since this is really kind of a cash surrogate, you want to make sure that cash is there when you need it and when you need to get your hands on it. T-bills are the most liquid investment. Plus, by the fact that they're short-term in nature, any realized gain or loss implications should be pretty nominal. Like I said before, we've used this with several clients over the years. One client we work with, County Reinsurance or CRL, recently put in place a 9-month laddered liquidity portfolio of T-bills Today, that portfolio yields 5.4%. So this strategy of a liquidity portfolio has a few advantages. One, it takes pressure off of harvesting liquidity or cash out of your long-term asset allocation. It limits realized losses, and it will improve your yield over just holding money markets. Now, money market yields have increased pretty significantly in the last several months, but in our experience, these liquidity portfolios tend to still provide another 40, 50, 60 basis points of extra yield compared to holding in a money market. Now, overall, the environment to build one of these portfolios today is actually pretty good because of the shape of the yield curve. With the yield curve inverted, short-term yields are higher than long-term yields. So there's really no opportunity cost to do this. Several years ago, when short-term yields were near zero, you did give up a fair amount of income to put this strategy in place. But today you don't have to, and we'd recommend pools that are facing cash flow crunches, think about putting something like this in place for your program. All right, so moving on to the second question, should we be making any changes to the strategy of our portfolio? And I'm going to address this primarily from the bond portfolio. The reason is I just talked about a 5.4% short-term yield. And when I say that to clients, sometimes the first reaction is, well, why don't we just buy all short-term investments if we can earn 5.4%? The table on the left shows treasury yields as of the middle of August. And you can see again that 5.4% one-year treasury yield versus the 5 years at 5.38%. So buying a 1 year gives you an extra 1%. Now, while that's tempting, if your liability cash flows are really more attuned to a 5-year type security, you can buy the 5 year today and lock in the 4.38%. If you buy the 1 year, you have to buy another bond next year when it matures. And then you have to buy another 1 year security after that. If interest rates have fallen in that time, that advantage you see today might go away pretty quickly. And in fact, if you look at the futures market, the market is pretty efficient. And the expected outcome of buying 5 1-year bonds is about the same as just buying a 5-year bond today. So in other words, if you go down just buying only short-term investments down that path, you really are just making a bet on the direction of interest rates in the future. And that's something we really caution against. As we've all learned over the last 2 years or so, the biggest risk facing investment grade bond investors is interest rate risk. When interest rates rise, bond prices fall. And what we have found to be the best long-term solution and long-term approach is not making interest rate bets, but rather, like I said earlier in this presentation, finding a duration or maturity profile of your assets that aligns pretty well with your liability. So while it's tempting today, you'll see underlined at the bottom, remain disciplined. And that's our advice to all of our clients and to anyone we talk to about considering deviations from your asset allocation approach. Okay, on to our third question. What sectors of the market do we find attractive today? And that's a little challenging to answer because of that short question at the top, recession or no recession. For the past year plus, as the Federal Reserve has raised interest rates aggressively, the idea that a recession is coming always seems just to be 9 months off. Every month, it's 9 months in the future, and you move forward to 3 more months. Well, in the recession, just 9 more months in the future again. Today, the narrative is changing a little bit, and there's this idea that we might have a soft landing, or the idea that the Federal Reserve can thread the needle and slow the economy just enough that growth slows but doesn't dip into a recession and inflation comes down. And that would be a really great outcome. Our view is that's not the most likely outcome, but it is possible. So given that backdrop of there might be a recession, there is a chance the Fed can engineer this appropriately. Some of the sectors we like today are on the left side of this page. First of all, agency mortgage-backed securities. These are pools of residential mortgages, which are issued by Fannie Mae, Freddie Mac, or Ginnie Mae, so carry a U.S. agency implicit or explicit guarantee. For years, the Federal Reserve was buying these securities as part of their quantitative easing program that started after the 2008 financial crisis. When you have an entity like the Fed buying bonds, They took all the excess yield that was available in that sector really out of the market because they continued to buy. Well, as the Fed is reversing policy today, not only are they raising interest rates, but they're also starting to step away from their purchases of the agency mortgage-backed securities market. With the Fed stepping back, excess yield has come into that sector and made it attractive again. We've been significantly underweight those securities in our portfolios for years, but today is the first time we are really adding to those in a significant way in our portfolios. And our view is, while we are earning excess yield to invest in those today, they'll also perform well given their government guarantee if there is some volatility or recession in the market. So that's one area of the market we're really focused on today. The next one, high quality AA or AAA rated taxable municipal securities. For a few reasons, we do not like tax exempt securities, particularly for pools, given the tax exempt nature of pooling. But overall, high quality taxable municipal securities offer a bit of a buffer in the portfolio. The yields of those securities tend to be comparable, maybe a little bit below high quality single A corporate bonds. But the volatility is somewhere between US Treasuries and corporate bonds in periods of stress in the markets. So we give up a little bit of yield. Instead of buying corporates, we get a little bit more yield than buying US Treasuries. And we have a bit of a buffer in terms of volatility. And it's been a nice position in our portfolios historically through cycles, particularly periods of volatility. On the corporate bond side, we've gotten a little bit more selective, and we're going up in quality a little bit more. So a couple of examples, we've been buying a number of utility bonds recently, those that have secured notes outstanding or being issued. Those tend to be high single A or AA rated and offering a reasonable amount of yield. And again, should perform well relative to the rest of the corporate market if there's volatility. We've also bought bonds like Pfizer in consumer non-cyclical kind of consumer staple type industries as well. We are not reaching for the last few basis points of yield in the corporate bond market today. And finally, asset-backed securities, or ABS, for shorter maturity securities, those backed by credit card receivables or auto loans, have performed really well through all cycles in the markets. And it's an area we still like today. On the right side of the slide, you'll see some areas where you're cautious. And the first is commercial mortgage-backed securities. And that is primarily driven by the fact that you cannot pick up the Wall Street Journal, listen to CNBC, or any other financial press without hearing about challenges potentially in commercial real estate, particularly in central business district office space around the country. And we agree, there will be challenges there. One thing to be aware of as you read those headlines, it's easy to come away with the impression that all of those are going to fail all at once, and this is all going to come to a head in the near term. However, I caution, if you think back to malls, as an example, on the retail side, we've been talking about the decline of malls for years, and we're just now starting to see some of those actually default. The timeline for offices might be different, but the idea is the same, that those are not all going to default at the same time. This is a cycle that will take a period of time to work out, and something to be cognizant of as you think about commercial mortgage-backed securities. We aren't avoiding that sector totally, but if you are going to invest in commercial mortgage-backed securities, our recommendation is to stay at the very top and the highest quality, most senior obligations. And you want to be really comfortable that whoever's buying those securities on your behalf is doing a fair amount of analysis on the underlying securities and stress testing the loans in each pool. I talked about, we do like some sectors of the corporate bond market. There are some we don't. And it really becomes sector by sector, but I'll give you a couple of examples. The auto sector has done actually really well. Car prices, as anyone's bought a car in the last couple of years, we know, car prices are up significantly. Auto sales still are relatively robust, and that has been really a tailwind for the autos. That said, we do have some concerns that the consumer might eventually get pinched and start to pull back. On top of that, the UAW has a contract negotiation coming up, which could certainly weigh on the autos as well. So that's an area we're cautious. Another area we're cautious in is the banking sector. Following the challenges in the spring with Silicon Valley Bank and others failing, and the volatility throughout the banking sector following that period, we really thought again about our banking exposure. We're comfortable with the exposures and portfolios today, but as we think about adding new names, even though the yields are relatively high, we want to be really thoughtful about the risk those banks have, not only near term, but longer term, because we think there might be bouts of volatility for banks ahead. So certainly an area to be cautious about. In the final one, highly callable securities, this would be on any list we'd ever put together for securities we're cautious about over time, but especially today. So the way those securities work, they might be a 5-year final maturity, but the issuer has the ability to repay you in 1 year, 2 years, 3 years, something shorter than maturity. What that means is the issuer has the option, if interest rates fall, to refinance into a lower rate. As the bondholder, that means we'd get our money back when rates are low and we'd have to reinvest. Those callable bonds do provide more upfront yield, but yields away from those structures are so high today, it's our preference that we'd be really cautious about investing in those and rather lock up more certain non-callable yields today to support long-term investment income. We've seen book yields on portfolios coming up significantly as interest rates have been higher. The longer we can keep those high book yields in our client portfolios, the better it is. And if you have a lot of callable securities, you run the risk of that falling again in the future. So before I wrap up, I'm just going to take a couple other comments away from the bond portfolio, things to think about in terms of sectors and allocations. And this really has to do with your risk asset allocation. Risk assets have had a tremendous year. S&P 500 is up 15% through the middle of August. The NASDAQ up even more with the AI craze. High yield bonds are up significantly. I alluded to this before. This is probably a good time to go back and think about your asset allocation targets you have in your investment policy statement. And you want to make sure you maintain those targets. Like I said, the relative percentage of those allocations did not change much in 2022 because everything fell about the same amount. This year, with the significant outperformance of risk assets relative to bonds, we've seen some portfolios where the asset allocation has really skewed more towards equities and away from long-term targets. And finally, if there is no asset allocation target in place, this is as good a time as any to go back and revisit that target and make sure you have one that's appropriate for your surplus or members' equity and your liabilities going forward. So to wrap this up, first of all, thank you for joining me today. 3 things to take away. I think first and most important is think about liquidity in your portfolio. That is going to be the biggest trigger to realize significant losses, and we want to avoid that in our risk pool portfolios. 2, while it's tempting, given the shape of the yield curve today, we'd recommend not changing your duration strategy and maintaining your long-term strategic targets for your bond portfolio. And finally, as prices have moved around, be careful how much risk you have in your portfolio today that you might not be aware of simply given to changes in market values. Again, thank you for joining me and look forward to meeting you at some point in the future.